In 2025, a fully occupied residential apartment complex in Houston sold at a 62% discount to its 2021 purchase price. The building had tenants, it had cash flow, it had a functioning roof, and it still sold for nearly two-thirds less than what the previous owner paid 4 years earlier. This is not a story about a distressed slum in a forgotten zip code. This is a story about how the mathematics of debt, interest rates, and capital retreat are quietly repricing American real estate from the inside out in ways that the official data has not yet fully acknowledged. This is not a housing crash in the way 2008 was a housing crash. There are no subprime liar loans. There are no CDOs stuffed with fraudulent mortgages. The problem in 2026 is structurally different and in many ways more difficult to resolve. In 2008, the government could identify the toxic instruments, quarantine them, and recapitalize the banks. What is happening now does not live in a specific product or a specific bank. It lives in the interest rate itself and the spread between what these buildings earn and what they now cost to finance. And that spread has not closed, it is widening. What I track is not headlines. I track capital flows, credit cycles, debt maturities, and the incentive structures that determine where institutional money moves and why. What those flows are saying right now is that the largest asset class in the United States is in the middle of a repricing event that the financial system has not yet fully absorbed, and that the mechanism by which it gets absorbed runs directly through the balance sheets of regional banks, municipal governments, insurance carriers, and ultimately the cost of borrowing for every American who takes out a mortgage. To understand why, you need to follow the timeline of decisions that brought us here. It begins in 2020 and 2021, when the Federal Reserve dropped interest rates to effectively zero, and the federal government injected over $5 trillion in fiscal stimulus into the economy. That combination of zero-cost capital and artificially elevated demand triggered one of the fastest appreciation cycles in commercial and residential real estate in American history. Property values surged, rent projections became aggressive. Sponsors and syndicators raised billions from retail investors to acquire apartment complexes, office towers, and mixed-use developments using short-term floating-rate bridge debt. The logic was straightforward. Rates were near zero. Appreciation was accelerating. You borrow cheap, you buy now, you refinance at similar rates in 2 or 3 years, and capture the equity. That logic required one assumption to hold, that rates would remain low. In March of 2022, the Federal Reserve began the most aggressive rate hiking cycle in 4 decades. By mid-2023, the federal funds rate had moved from near zero to over 5%. The cost of short-term floating rate debt, the exact instrument that syndicators and developers had used to finance the boom, moved in direct lockstep. An apartment complex financed at a 3.2% bridge rate in 2021 was suddenly looking at refinancing costs of 7, 8, or even 9%. The income the property generated had not doubled. The debt service had. This is not metaphor, this is arithmetic. And arithmetic does not negotiate. What followed was a slow-motion acknowledgement of a problem that the industry spent the better part of 2023 and 2024 hoping would resolve itself through a Federal Reserve pivot that never fully materialized. By the beginning of 2026, approximately $1.5 trillion in commercial real estate loans are sitting at or near their maturity dates, requiring refinancing in a rate environment that makes the underlying math functionally impossible for a significant percentage of those assets. The Urban Land Institute estimated in late 2025 that nearly 40% of commercial real estate loans maturing in the next 24 months cannot be refinanced at current rates without the borrower injecting significant new equity. That equity, in most cases, does not exist. Blackstone defaulted on a $562 million commercial mortgage-backed security tied to a portfolio of Finnish office buildings. Brookfield walked away from 2 prominent Los Angeles office towers totaling over $1 billion in book value, handing the keys back to lenders rather than defend the equity. These are not marginal operators. These are the most sophisticated real estate capital allocators on the planet. When they walk, the signal to the market is unambiguous. The equity is gone. The building is worth whatever a distressed buyer will pay, and distressed buyers do not pay par. The extend and pretend mechanism is what is keeping the official data from reflecting the true severity of the repricing. Banks are granting loan extensions of 12 to 24 months to commercial borrowers rather than forcing the recognition of a loss. Regulators have quietly issued guidance allowing banks to modify and restructure loans without triggering standard impairment classifications, a policy known internally as the Commercial Real Estate Workout Guidance. The practical effect is that hundreds of billions of dollars in effectively impaired loans are sitting on bank balance sheets at values that bear no relationship to what those properties would actually sell for in the open market. The Federal Reserve's own Financial Stability Report, published in May 2025, flagged commercial real estate as one of the three primary vulnerabilities in the U.S. financial system. It noted that bank exposure to the sector is concentrated, that valuations remain elevated relative to income, and that the maturity wall presents a near-term credit risk. That language, in the measured bureaucratic register of central bank communication, is the equivalent of a 5-alarm warning. The Fed does not use the word vulnerability lightly. Regional banks are the load-bearing wall in this structure. Institutions with assets between $1 billion and $100 billion hold approximately 67% of all outstanding commercial real estate loans in the United States, according to data from the Federal Reserve Bank of New York. The too-big-to-fail institutions, J.P. Morgan, Bank of America, Wells Fargo, have the diversified balance sheets and the capital buffers to absorb a significant commercial real estate write-down without existential risk. The regional banks do not. New York Community Bancorp disclosed in early 2024 that it had significantly underestimated the credit risk in its commercial real estate portfolio and took a provision for loan loss expense that caused its stock to fall over 60% in a matter of days. That bank did not fail. But the sequence of events it experienced, the surprise disclosure, the stock collapse, the rating agency downgrade, the emergency equity raise at dilutive terms, is the template. And that template has not yet been applied to the full scope of regional bank exposure. The office sector is the sharpest edge of this repricing, the structural shift toward hybrid and remote work, accelerated by the pandemic, but now calcified into corporate real estate policy, has produced vacancy rates that are genuinely without modern precedent. Office vacancy in San Francisco crossed 37% in 2025, according to CBRE data. Chicago reached 25%. Manhattan, long considered the most resilient office market in the world due to the density and prestige of its tenant base, crossed 22% in the second half of 2025, with Class B and Class C buildings experiencing effective vacancy well above that figure. In markets like Washington, D.C., where government leasing historically provided a stable demand floor, vacancy has climbed past 21% as federal agencies consolidate footprints under budget pressure. These are not numbers that correct quickly. Office leases run 5, 10, and 15 years. The vacancy being reported today reflects decisions that tenants made in 2022 and 2023 when their leases came up for renewal, and they chose to take less space. The leases signed at peak pandemic recovery optimism in 2021 and 2022 for full floors of space that companies now realize they do not need, those leases will expire between 2026 and 2028. When they expire, the rollover to smaller footprints will push vacancy rates higher still. The office repricing is not at the midpoint. It is still in the early chapters. The effect on net operating income is direct and compounding. When vacancy climbs, rental revenue falls. When rental revenue falls and debt service is fixed or rising, the debt service coverage ratio, the ratio of income to debt payment, drops below 1. A building that collects less in rent than it pays in debt service is technically insolvent. It is only the patience of the lender, expressed through extensions and modifications, that keeps it legally operational. That patience has a cost. The deferred recognition of loss accumulates on bank balance sheets like water behind a dam. The dam does not fail gradually. It holds until it does not. The residential market is experiencing a structurally different but equally significant form of compression. The lock-in effect, the phenomenon where homeowners with 2.75% or 3.1% 30-year fixed mortgages refuse to sell, because doing so would require them to re-enter the market at 6.8% or 7.1%, has produced an inventory freeze that kept nominal prices elevated throughout 2023, 2024, and into 2025. The National Association of Realtors reported that existing home sales in 2024 fell to their lowest annual volume since 1995, not because demand collapsed, but because supply refused to come to market. This is a market that appears stable on the price axis while being profoundly broken on the transaction axis. The affordability math tells the real story. The median existing home price in the United States reached approximately $425,000 in mid-2025. At a 7% 30-year fixed mortgage rate with a standard 20% down payment, the principal and interest payment on that purchase is approximately $2,265 per month. Add property taxes, homeowners insurance, and, in flood or wildfire-exposed markets, supplemental hazard coverage, and the all-in monthly payment crosses $3,200 to $3,800 in most major metropolitan markets and exceeds $4,000 in high-cost states. The median household income in the United States is approximately $80,000 annually, or about $6,667 per month before taxes. Housing economists use 28% of gross income as the traditional affordability threshold for housing costs. 28% of $6,667 is $1,167. The market is asking for more than twice what the affordability threshold permits for a median home, financed by a median household. This is not a gap that closes when sentiment improves. It closes when prices fall, when rates fall, or both. The Federal Reserve has moved rates modestly lower from their peak, but not to a level that restores affordability at current prices. And prices have not fallen meaningfully in nominal terms because the inventory freeze prevents the price discovery that a functioning market requires. What you have instead is a market that has stopped clearing. Transaction volume remains near historic lows. The pool of actual buyers capable of qualifying for and servicing a mortgage at current prices and rates has narrowed to a fraction of households who would historically be first-time buyers. The generational home ownership pipeline, the mechanism by which wealth is transferred through property equity across generations, has mechanically broken down. The insurance market is an accelerant that is compressing the housing market from an angle that the standard rate and price analysis misses entirely. Major carriers have not simply raised rates. They have executed what is, functionally, a capital withdrawal from risk-exposed geographies. State Farm non-renewed approximately 30,000 homeowner policies in California in 2023 before pausing new business in the state entirely. Allstate followed. In Florida, the private market retreat has been so significant that Citizens Property Insurance, the state-backed insurer of last resort, now insures more than 1.3 million policies, a volume it was never designed to sustain, and that represents a contingent liability for Florida taxpayers that has not been fully priced by the bond market. In Louisiana, 12 insurance companies became insolvent between 2021 and 2023 due to hurricane-related losses, leaving policyholders stranded mid-contract. The financial mechanism of the insurance withdrawal is precise. If a property cannot obtain hazard insurance coverage, it cannot be financed by any conventional lender. Fannie Mae and Freddie Mac require continuous coverage as a condition of the mortgage. A property that loses its insurer and cannot replace it at any price is, for practical purposes, unmortgageable. An unmortgageable property can only be sold for cash. Cash buyers, who are typically institutional or distressed investors, require a significant discount to compensate for the illiquidity and risk premium. In coastal Florida and wildfire-exposed California communities, this dynamic has begun producing exactly the kind of distressed transaction prices that will eventually force appraisers and lenders to recalibrate their valuations on surrounding properties. The insurance cost increase for properties that retain coverage is itself a form of hidden affordability compression. Homeowners in Florida who purchased properties in 2019 with insurance premiums of $3,000 to $4,000 annually are now receiving renewal notices at $9,000, $12,000, and in some coastal zip codes, $18,000 to $20,000 annually. That delta, $6,000 to $15,000 per year, or $500 to $1,200 per month, is not reflected in the quoted mortgage payment that prospective buyers use to evaluate affordability. It is disclosed in the escrow estimate, frequently after the buyer is emotionally committed to the purchase. The effective monthly cost of ownership in these markets has increased 30 to 50% from insurance alone, independent of any movement in interest rates or purchase prices. Property tax escalation is the third layer of the hidden cost compression, and it operates through a mechanism that is structurally perverse. When the pandemic-era appreciation cycle pushed assessed values significantly higher, local governments captured the nominal gains in the form of substantially increased tax bills, even as the underlying income capacity of the household did not change. California's Proposition 13 provides a cap on assessed value increases for existing owners, but it creates a cliff for new buyers who absorb the full market rate assessment at purchase. A buyer who purchases a California home at $900,000 faces a property tax bill of approximately $9,000 annually. Their neighbor who purchased the identical home in 1998 for $180,000 pays under $2,500. This assessment asymmetry creates a carrying cost penalty for new entrants that compounds every other affordability pressure already present in the market. In states without Proposition 13-style protections, particularly Texas and Illinois, assessed values have been reset aggressively following the appreciation cycle. Homeowners in suburban Austin who purchased in 2019 at $280,000 and watched their properties appreciate to $550,000 by 2022 are now carrying property tax bills that reflect the peak assessed value, even as the market has pulled back from those peaks. The tax follows the peak, not the current price. Several Texas counties have seen effective property tax burdens on single-family homes reach 2.5 to 3.2% of assessed value annually, which at a $500,000 assessment generates a tax bill of $12,500 to $16,000 per year, or over $1,000 to $1,300 per month before a single mortgage payment is made. The municipal government exposure to the commercial real estate repricing is a secondary consequence that will unfold over a longer timeline, but carries significant systemic weight. Commercial property taxes, primarily from office towers, retail centers, and industrial facilities, constitute a substantial portion of the municipal revenue base in major American cities. Chicago derives approximately 40% of its property tax revenue from commercial properties. New York City's commercial real estate sector contributes billions annually to the city's operating budget. When these properties reprice downward following distressed sales and successful tax assessment appeals, that revenue base contracts. Tax assessment appeals are already being filed in significant volume. A building that sold for 30 cents on the dollar relative to its previous assessment has a straightforward legal basis for challenging its current tax bill. Law firms specializing in commercial property tax appeals have reported a significant increase in caseload as institutional owners pursue every available tool to reduce operating costs on distressed assets. When these appeals succeed, and they frequently do following verifiable market transactions at discounted values, the municipality absorbs the revenue loss. That loss must be either offset by cuts to public services, transferred to residential property owners through rate adjustments, or financed through additional bond issuance. Each of these outcomes carries its own set of second-order consequences for the creditworthiness of city and county governments. The credit rating agencies are beginning to reflect this dynamic. Several mid-size American cities have received negative rating outlooks or explicit downgrades in the past 18 months, tied in part to commercial real estate revenue uncertainty. Municipal bonds from these issuers have widened their yield spreads relative to comparable treasuries, indicating that the fixed income market is beginning to price in fiscal risk that was not present in the prior cycle. Pension funds and insurance companies that hold these bonds as core fixed income allocations are watching the credit quality of what they presume to be low-risk assets quietly deteriorate. The shadow banking sector's exposure to this repricing is the layer that is most difficult to quantify and therefore most likely to produce the kind of surprise that markets have not prepositioned for. Private credit funds, which stepped aggressively into real estate lending as regulated banks pulled back following the 2008 financial crisis, now manage an estimated $1.7 trillion in assets with significant commercial real estate exposure. These funds raise capital from pension funds, sovereign wealth funds, university endowments, and high net worth individuals. Unlike regulated banks, they do not mark their loan books to market on a daily basis. They report valuations on a quarterly or semi-annual basis, using models that do not necessarily reflect the prices achievable in a distressed transaction. This valuation lag is not fraud. It is a structural feature of private market accounting that creates the appearance of lower volatility relative to publicly traded instruments. When a public REIT that owns office buildings sees its stock price fall 45%, the loss is immediately visible to every market participant. When a private credit fund holds a loan against a similar office building that is experiencing the same deterioration in fundamentals, that loss does not appear in the reported net asset value until the fund's manager chooses to reflect it, or until a realized transaction forces the recognition. Investors in these funds believe their portfolios are performing because the reported numbers have not yet absorbed the reality of what the underlying assets are worth. The gap between reported value and realizable value in private credit and private equity real estate funds is, by several institutional estimates, substantial. The interconnection between commercial real estate stress, regional bank capital adequacy, municipal fiscal health, insurance market availability, and household affordability is not a collection of separate concerns. These systems operate as a single organism. The stress that originates in a maturing commercial real estate loan flows through the bank that holds the loan, into the municipality that depends on the property's tax contribution, into the insurance market that prices the region's risk, and ultimately into the household that is trying to evaluate whether buying a home in that market makes financial sense. Each node in the system is transmitting pressure to the next. None of them are operating in isolation. What happens from this point is not a matter of prediction. It is a matter of identifying the mechanical sequence that unfolds when the extend and pretend capacity of the banking system is exhausted. That capacity has a finite limit. Extensions require regulatory tolerance, borrower cooperation, and the credible hope that conditions will improve before the next extension expires. Each of those conditions is degrading. The Federal Reserve's rate trajectory has not produced the dramatic decline that would meaningfully restore the refinancing math for the most distressed assets. Borrowers who have received multiple extensions are approaching the point where lenders require resolution rather than additional forbearance. And the regulatory posture, after years of accommodation, is beginning to shift toward requiring more accurate recognition of credit risk. The Bank Term Funding Program, which the Federal Reserve established in March 2023 to provide liquidity to banks holding underwater bond portfolios following the Silicon Valley Bank failure, expired in March 2024. The backstop it provided, the ability of banks to pledge assets at par value regardless of market value in exchange for short-term liquidity, is no longer available. Banks that subsequently face deposit outflows or liquidity stress must raise cash by selling assets at market prices, which for commercial real estate collateral means accepting the losses they have been deferring. The refinancing wave that is building through 2026 and peaking in 2027 will force a resolution that the market has not yet priced. Properties will transact at distressed values. Banks will recognize losses. Some will require capital raises. The credit rating agencies will respond. Lending standards will tighten further, compressing the pool of credit-eligible buyers and borrowers. Municipal revenues will face downward pressure as successful tax appeals reduce assessed values. Insurance carriers will continue to reprice or withdraw from climate-exposed markets as the reinsurance market, which provides the capital that underwrites retail insurance, absorbs losses from increasingly frequent catastrophic events, and adjusts its pricing accordingly. What does not happen in this sequence is a sudden, discrete collapse. The mechanism is more gradual and more structural than that. It is a repricing cycle, not a detonation. Assets find new owners at new prices. Some banks are absorbed by stronger institutions before they fail publicly. Some municipalities restructure their finances before they reach a default trigger. The process is slow enough that most participants rationalize each individual development as manageable, while the cumulative effect of hundreds of individual resolutions accumulates into a structural shift that reshapes the market for years. The coming months carry several specific inflection points worth monitoring. The maturity calendar for commercial mortgage-backed securities is public record. Billions in CMBS loans originated in 2021 and 2022 at the peak of the market are scheduled to mature through 2026 and 2027. The special servicer transfer rate, which measures the percentage of CMBS loans being moved from performing to workout status, has been rising steadily. When it crosses certain thresholds, it triggers automatic reviews by rating agencies that can lead to downgrades of the bonds backed by these loans, forcing institutional investors who are prohibited from holding below investment grade paper to sell, creating additional downward price pressure. The Federal Reserve's next several rate decisions will determine how much breathing room the extend and pretend mechanism retains. If rates decline meaningfully, some portion of the maturity wall becomes refinanceable, reducing the severity but not eliminating the repricing. If rates remain elevated or decline only modestly, the mathematics of the crisis remain unchanged, and the resolution must come through value discovery rather than rate relief. State-level insurance regulatory decisions in California and Florida will determine how broadly the coverage withdrawal extends. Both states have opened proceedings regarding insurer rate-setting rules, attempting to create conditions under which carriers will return to markets they have exited. The outcome of those proceedings will have direct implications for property values in two of the largest real estate markets in the country. If insurers do not return, the unmortgageability problem expands. If they return at rates that reflect the actual risk, the all-in cost of ownership rises further, compressing affordability from yet another direction. Municipal bond issuers in commercial real estate-heavy cities will face refinancing decisions of their own as their outstanding bonds mature. The spread at which they can issue new debt will reflect the market's assessment of their fiscal position in a lower commercial property tax environment. If spreads widen significantly, it raises the cost of financing city infrastructure and services, creating a public sector affordability problem that mirrors the private sector dynamic. None of these sequences have a predetermined end. They are processes in motion. The data is available, the structural pressures are identifiable, the incentive structures of every participant, the bank that wants to avoid loss recognition, the municipality that wants to maintain its credit rating, the insurer that wants to price risk accurately, the institutional investor that wants to maximize recovery value, are all legible and are all producing outcomes that are flowing through the system in measurable ways. The experts are not hiding this information. The information is in regulatory filings, rating agency reports, Federal Reserve publications, and CMBS servicer data. The market is absorbing it more slowly than the underlying conditions warrant, which is precisely the dynamic that defines every repricing cycle in the history of credit markets. The process is not over. The data is still arriving. The maturities have not yet fully hit. The insurance market withdrawal is still expanding geographically. The municipal fiscal reckoning is still building. The extend and pretend window is still closing. What is already visible in the data is sufficient to understand that the repricing of American real estate, commercial and residential, is structural in origin, systemic in its interconnections, and still in the earlier stages of what is likely to be a multi-year adjustment cycle. If you're tracking this story through the institutional data, follow the CMBS special servicer transfer rates, the regional bank call reports filed quarterly with federal regulators, the reinsurance pricing indices published by Guy Carpenter and Aon, and the municipal bond credit spread data published weekly by Bloomberg and the Municipal Securities Rulemaking Board. These are the data sets that reflect what is actually happening before it becomes a headline. The structure of this market is still unfolding, the numbers are still coming in.